We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
Rate cut hopes collapsed as the odds of a December Fed cut plunged from 70% to 46%, sending yields higher and pressuring growth in AI equities. Beneath a flat S&P, markets punished high beta risk with the Russell 2000 down nearly 2%, while Europe staged a fragile relief rally despite soft industrial data and weakening German sentiment. The UK stumbled hard on rising unemployment, stagnating GDP, and a shock 28% drop in auto production, driving a surge in bets on a Bank of England cut. In Asia, Japan gained on fiscal optimism and a weaker yen, while China slipped as industrial output, retail sales, and investment all deteriorated to record weak levels.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
If you were looking for a quiet week, well, you were in the wrong place. Global markets just spent 5 days violently resetting their expectations.
And not based on hard data,
Yeah.
which is the key. This was all about pure central bank psychology.
It was a week just defined by contradiction, a massive mood swing.
Absolutely.
Yeah.
You have the end of the longest U.S. government shutdown in history, which should have been a moment of clarity.
Should have been.
But instead, we got these 3 major dynamics that just overshadowed everything. Rate cut hopes, poof, they just vanished.
Gone.
AI-heavy equities came under some really intense pressure, and the overall macro picture just felt profoundly fragile.
That's the triple threat right there. The post-shutdown fade, the AI jitters, and that huge reversal on the Fed, which you can see in that one number. The odds for a December cut dropping from nearly 70% to just 46%.
So today, we're cutting through that noise. We're diving into the regional specifics, U.S., Europe, U.K., and Asia, to see who really won, who stumbled, and most importantly, what you need to be tracking next week.
Okay, let's start where the action, or maybe the lack of action, was most striking, U.S. markets.
Right.
You look at the S&P 500, and you might think nothing happened. It finished basically flat. But that is completely deceptive, isn't it?
Oh, it hides a vicious rotation underneath. I mean, while the S&P was stable, investors were clearly punishing 2 major areas.
Okay.
First, the high-flying growth names.
Yeah.
That's the NASDAQ story, which dipped about 0.5%. And second, speculative risk. The Russell 2000 took the biggest hit, dropping almost 2%.
So this wasn't a general sell-off?
No, not at all. It was a targeted clearing out of the highest risk bets on the table.
And this all happened right as the 43-day government shutdown was finally ending. You'd think the market would celebrate.
You would think. But it didn't, and I think that comes down to one thing. A complete data vacuum.
We're flying blind.
Precisely. We are operating in a serious fog. I mean, the good news is we finally have a date for the delayed September jobs report. That's Thursday, November 20th.
But think about that. We are almost in December, and we still don't even have a schedule for the October jobs data.
The Fed, the market, everyone is just guessing at what current labor conditions look like.
And this is where the psychology just took over. That huge reversal in rate expectations. A week ago, a 70% chance of a December cut. Now we're at 46%.
A massive shift.
What drove it if we don't have the data?
Pure rhetoric. It was pure Fed speak, and the market finally started believing their cautious tone.
So they're finally listening.
They are. Fed officials were, uniformly stressing the need for patience. They kept highlighting these persistent pockets of inflation that they're just not comfortable with.
The message was what? Don't get ahead of yourselves.
The message was crystal clear. Don't bet on a December cut just because the government is open again. We're going to wait for the data to confirm deflation, not just assume it's happening.
So that hawkish talk hits growth stocks. It pushes bond yields up. The 10-year Treasury drifted higher, right? It hit 4.15%.
It did.
But the market didn't collapse. So what was the floor? What held it up?
Corporate America. This is a critical distinction for you to make. While the macro was a mess, Q3 earnings were Phenomenal.
Better than expected.
Way better. They're tracking at 13.1% year-over-year growth. That smashes the 8% or so we were expecting. It tells you the consumer is still spending, companies are resilient, and profits are strong.
Okay, so that's a huge buffer. Now let's leave the U.S. data fog and cross the Atlantic. Because while the U.S. was stuck, Europe actually felt like it had a genuine relief rally.
It really did. The SATO XX Europe 600 was strong, up almost 1.8%. And the big standouts were France and Italy.
Their indices were up sharply.
Yeah, the CAC 40 and FTSE MA, they were riding that immediate psychological wave from the U.S., political clarity. And they also had some decent industrial output numbers of their own.
But here's the question, is that strength built on sand or rock?
If we connect this to the bigger picture, it's closer to quicksand. The relief was real, but the underlying macro story is fragile. Well, for instance, Eurozone industrial production only rose about 0.2% in September. That was below expectations. And then you saw these really critical warnings coming out of Germany.
You're talking about the ZEW commentary. For anyone who doesn't track every single acronym, what does that tell us?
The ZEW is basically Germany's investor sentiment barometer. It's how institutional money feels about the outlook. And that sentiment weakened a lot.
So they're worried.
They're worried. The commentary highlighted these profound doubts about Berlin's ability to fix deep structural issues. So that rally felt good for a moment, but the long-term confidence just isn't there.
And that sense of fragility seems to have jumped right across the channel because the UK market, the FTSE 100, was completely flat.
The UK story was a true macro shock. It's probably the most complex situation globally right now. They digested one of the weakest single sets of economic updates all year.
It could give us the details. What hit so hard?
All right, so you saw unemployment rise to 5%.
Which is the highest since 2021.
Exactly. Highest since 2021. Then wage growth is clearly cooling off. And the growth numbers themselves were just dismal. Q3 GDP, a tiny 0.1% gain.
Yeah.
And September actually contracted.
Near stagnation.
It is. But here's the one anecdote that tells the entire story of how vulnerable that economy is right now.
Go on.
A single localized cyber attack at Jaguar Land Rover was so severe, it sent overall UK car production down. Get this, 28.6% in September.
Wow.
It's a profound example of just how thin their manufacturing margin for error is.
And that kind of data has to change the central bank calculus, right?
Absolutely. Instantly. The implication is crystal clear. This string of soft data pushed investors to sharply, and I mean sharply, raise their bets on a December rate cut from the Bank of England. The market is basically daring them to ease policy.
Okay, let's pivot to Asia. Two totally different paths being forged by Japan and China. Let's start with Japan, where we actually saw some strength.
We did. Japanese equities drifted a bit higher, but it was fueled entirely by optimism around policy. The new Prime Minister, Takaichi, is signaling a more flexible, more aggressive fiscal spending approach.
Which immediately did what to the yen?
Weakened it, a key driver for their exporters. The yen fell to 154.6 per dollar.
So the market likes the fiscal spend. What about the Bank of Japan?
The path to normalization is still there, but it's not speeding up. Markets are now looking at January, not December, for the next rate hike.
Even with Ueda saying inflation is moving towards their target.
Even with that, yes. He's saying inflation is moving gradually, and the market is hearing gradually and thinking January.
And was there any hard data to back up this optimism?
There was, actually. The Reuters Tankan manufacturing gauge jumped to plus 17. That's its highest level since 2021. And for anyone unfamiliar, the Tankan is Japan's key confidence barometer. That reading suggests real business optimism.
Okay, now contrast that with China, where momentum just seemed to evaporate.
It really faded. The Shanghai Composite was down a bit, and they were dealing with a whole new batch of disappointing numbers. Industrial production missed, retail sales slowed for the 5th month in a row.
But the real story is the investment slump, right?
That's what's truly fascinating, and it highlights the structural pain. Fixed asset investment fell 1.7% year to date. That is the worst performance on record.
So their old growth drivers are just failing.
They are. The housing pain is just relentless. New home prices fell. Existing home prices slid even more. Those headwinds are a major anchor on growth.
And yet, most economists still think Beijing can hit its 5% growth target this year. Is that just stimulus hope?
It is almost entirely dependent on that policy pipeline. Their optimism rests on that recently approved 1 trillion RMB in fiscal measures. If Beijing falters or delays in deploying that cash, global sentiment is going to get very spooked.
Okay, that's a clear picture of the week. Now let's look forward. The U.S. data fog is lifting. The calendar for November 17th through the 21st looks explosive.
It really is. The U.S. focus is all on Thursday, November 20th, the delayed September jobs report. This is it. The first piece of concrete high-impact data we've had since the shutdown began.
And we also have Fed minutes on Tuesday and consumer sentiment on Friday.
Correct. A very busy week for the U.S.
What about globally? What are the key moments to watch?
So for Europe and the U.K., Friday the 21st is the big day. We get the flash manufacturing and services PMIs for both Germany and the U.K.
So our first real look at Q4 momentum.
Exactly. We'll see if that relief rally has any legs. Also watch UK inflation on the 19th and retail sales on the 21st. Those are huge.
And for Japan, their whole policy decision seems to hang on two numbers.
It does. Monday the 17th, we get Q3 GDP, and Friday the 21st is the October inflation rate. If GDP is weak and inflation holds, it makes a January hike very, very hard to justify.
All right, now for the checklist you need. The 5 critical risks investors should be paying attention to right now. These are the pressure points.
Right. What truly threatens this very, very fragile equilibrium we're in?
Let's start with number 1, the most immediate threat.
It has to be the U.S. jobs data, even though it's delayed. If that September report comes in strong job creation, rising wages, it instantly reshapes the entire debate.
And that 46% chance for a December cut?
Could go to 0 overnight.
Okay, number 2. Back to the UK, which feels like it's on a knife edge.
It is. The UK inflation and retail sales reports. This is a non-negotiable test for the market's bet on a December rate cut. This data either justifies that bet or it completely reverses it.
Number 3, Japan's moment of truth.
Japan's GDP and inflation figures. These numbers will tell us if a January BOJ hike is actually justified by the economy or if it's just based on their own guidance. If the numbers are soft, the yen could really accelerate its slide.
4th, the litmus test for Europe.
The Germany and UK PMIs. Those flash ratings are our first signal for Q4. If they come in weak, that European relief rally we just saw will stall out immediately.
Finally, number 5, the foundation holding up so much of the global picture.
China's policy pipeline. It is absolutely critical.
Yeah.
Q4 data is cooling. Any delay in deploying that 1 trillion RMB in stimulus could scoop global markets, especially given the investment slump they're already in.
So what does this all mean for you? Global markets absorbed the end of the U.S. shutdown, but the enthusiasm was muted. The political gridlock was just replaced by a data vacuum and a hawkish Fed.
Yeah, the key takeaway is that the market is stuck. It's caught between really strong corporate earnings on one hand and softening macro data on the other. And while Europe and Japan saw bright spots, the underlying structural issues are still there.
Volatility is almost certainly ahead as that clarity slowly returns.
The data fog is lifting, but the market might not like what it sees underneath. Whether it's sticky inflation or a sudden slowdown, the caution right now is definitely warranted.
And here's the final thought to mull over. That 46% chance of a Fed rate cut is the most fragile bet in finance right now. If that delayed September U.S. jobs report lands hot on Thursday, how quickly does that probability go to 0? That single question is the entire pressure point for the next week.
Track that data closely.
We'll catch you on the next deep dive.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.